Hi everyone, I just wanted to mention a couple things about corporations, about Chapter 13. Chapter 13 of course is not required, it's all extra credit. But one thing that I wanted to mention is that the way a corporation obtains a charter is from the state. And in that charter they're going to be authorized to sell X amount of stock, X amount of shares of stock. So a corporation, when they're determining, of course, how many stock they want to be authorized to sell, they're not only planning for what they want to do today, they're planning for what they want to do later on. So they're thinking about everything, today and the future. Some advantages of the corporate form of business, of course it's the largest form of business in the United States. Some advantages are ease of share transfer. If you want out, you just dispose of your stock, right? Very simplistic. If you own public stock and it's trading on the New York Stock Exchange, for example, you want to sell stock, easy enough. You just go ahead and sell that stock. If you want to buy stock, again, you can buy it. So it's a lot of ease in that transferability. A corporation is a separate legal entity in and of itself. There's limited liabilities of owners of a corporation. So all you can lose is what you invest. If I invest $100,000 in a corporation, I can only lose $100,000. If that corporation goes out of business and owes millions of dollars, nobody's going to come to you and ask for that money. And of course, it has a continuation of life. It's got continuous life. So unlike a partnership, for example, if one of the partners were to die and the partnership would end, corporation, if their CEO were to pass away, the corporation, of course, would go on. They don't own it. That CEO would just be in charge of it, or generally. Two things that enhance the ability to obtain capital for a corporation are the ease of share transferability and limited liability of owners, because owners have limited liability. So it does help to enhance the ability to obtain some capital. Board of directors are elected by your stockholders. That's who is electing the board of directors. Some disadvantages of a corporation are double taxation. So the corporation is taxed on its net income, and then when the corporation pays out dividends, the stockholders who receive those dividends are also taxed. So there is double taxation, and government regulations, much heavier with a corporation. There are privately held corporations. Those are corporations where the stock is not publicly traded. You cannot buy that on the New York Stock Exchange, for example. It is closely held sometimes, but it is private. If you only have one class of stock, there's only one class outstanding, that class of stock is going to be common stock. You can, of course, have more than one class of stock outstanding, but if you do only have one, then it's common stock. And those were pretty much the high points of the chapter. I was going to go over some various journal entries, but this is pretty much the main parts of the chapter. There's other information in the book, of course, but I think it was pretty clear in this chapter. So again, I will go ahead and do some journal entries.